Hi everybody, this is Phil Holoka from Complete Captive Management Services, and today we're going to talk about federal income tax as it's related to captive insurance. So before I jump into this, let's have a frank discussion. Taxation is a very complicated subject. This stuff is very easy to explain, but your specific tax situation is very complex and it warrants a qualified tax consultant. I'm not that, so don't take what I'm saying for your tax advice. Okay, captives. They are either onshore or offshore. If you're an onshore captive, that simply means that your captive is registered as an insurance company in one of the 50 states within the United States. And as such, you're then registered as a C corporation, which means you're a federal income taxpayer. That simple. Now, if you're an offshore registered captive insurance company, you have the choice to elect what's called the 953D election. And what that allows the foreign captive insurance company to be recognized and treated as a federal income taxpayer. Okay? So what we're going to talk about here, you're assuming that it's either an onshore captive or the offshore captive has elected the 953 election. That's all we're talking about today. Nothing too granular. So you've seen this before. This is a profit and loss statement. $1 million of premium revenue. You have $100,000 of SG&A expenses, sales, general, and administrative expenses. And then you have $300,000 of actual insurance policy losses. So you would think that your captive has earned $600,000 of profit. Well, not so quick. You have to have what's called an IBNR. The IBNR stands for Incurred But Not Reported. That's when an insurance company makes an estimate of what claims are still pending out there. Because you may have a claim on November 1st, but there may be many more claims after that that just may not hit until after the tax return is due for that calendar year or that fiscal year. So you have to accrue an IBNR. Now, this assumption, this estimate, we're saying $400,000 are out there that we just don't know are out there yet. So we're making an estimate. Now, the captive manager isn't qualified to make that estimate. The captive owner isn't qualified either. This duty is given to the actuary. Now, if your captive is an A&H captive, there are specialties for actuaries in the A&H market. Or if your captive is a P&C captive, there are actuaries that specialize in the P&C side. So this $400,000 ultimately reduces your underwriting profit. This is called a temporary difference because this $400,000, we don't know if that's a real number or not. It's an estimate. So that leaves $200,000 of profit, bottom line profit. And because you're a C corporation, your tax expense is 21% of $200,000 or $42,000. That leaves retained earnings for the first year of $158,000. That's pretty simple. In year 2, you're growing. That's good. SG&A expenses are about the same. Claims are even better. You're doing something right, or you're having a good year. That's leaving $900,000 of underwriting profit. However, the $400,000 of IBNR that you estimated last year, only $100,000 developed, which means you've got to add back $300,000 because the full $400,000 never developed. So for this year, the actuary says you're having a better year, therefore we think your IBNR is less, so we're going to book $200,000 this year, but we got to add back the $300,000 from last year, so now your total profit is $1 million. Therefore, you owe 21% of $1 million. The one thing that you have to be aware of, this IBNR number, the captive owner may have a motivation to say, no, actuary, I want my IBNR to be $500,000. Therefore, I want to be a lower profiting company and ultimately pay less tax. Well, that's not good. Not good business practice. Because as I just mentioned, you can book $500,000 here, but it's going to come back this year. You cannot escape the IBNR estimate because it is adjusting every single year. In fact, if we had a third year here, you would see maybe this only developed $100,000, which means we would be adding back $100,000. Or maybe we didn't estimate enough and we actually had $300,000. Then this would be a negative $100,000 in the third year. So you have to be aware of the IBNR. You can't be too aggressive. It's always going to come back and true up in each of the following years. So, hope this was helpful. We're going to talk about underwriting profits and how they're taxed next week. So until then, have a good week. Bye now.